Hi, my name is John Collins, and I'm a senior loan originator with Southwest Funding. You'll have to forgive me today. I have a slight head cold, but I wanted to get this information out to you because I thought it was important. This is our second in a series of videos about the pre-qualification process to buying a home. In our last video, Demystifying Credit Reports, we talked about what items are included in a mortgage tri-merge credit report and what steps you can take to keep your score healthy. Today, we want to talk about how your mortgage professional will determine how much loan you qualify for. There are several factors that we look at, including your gross monthly income, your total monthly debts on your credit report, and the proposed monthly payment of the new house. In very simplest terms, there are two ratios that are looked at when pre-qualifying a buyer. The first is what is called the front-end ratio, which looks at your total income versus the proposed monthly payment. The other ratio that the loan consultant will look at is called the back-end ratio, and this ratio includes the total monthly payments found on your credit report, added to the proposed monthly payment of the new house. Today we're going to talk about the back-end ratio, since that is the one that the lender is going to look at more closely, although both the front and the back-end ratio are important. The first thing we need to determine is your gross monthly income. This is the amount of money you make before your employer takes out any taxes or other deductions, such as medical insurance from your check. If you're an hourly employee, this would be your hourly rate times the number of hours you work in a week. For example, let's say you're paid $20 per hour and you work 40 hours a week. This comes to $800 per week. Then multiply the $800 per week by 52, since there are 52 weeks in a year, and this would give you an annual income of $41,600 per year. But remember, we want your monthly gross income. So divide your annual gross income of $41,600 by 12 months, and your monthly gross income is $3,466 per month. If you receive a set salary, it is much simpler to determine your monthly income. Just take your annual salary and divide it by 12 months. Voila, this is your monthly gross income. If you're self-employed, it's a little more difficult to calculate, and you will need 1 or 2 years of your personal and or business taxes to calculate. If you would like more help calculating your self-employed income, I recommend getting a hold of your mortgage professional. Okay. Now we have your monthly income, but there are other sources of income we can add to this number, such as child support, Social Security, pension, and other like items. When you have the total amount of income you make monthly, set this number aside and let's move on to the second part of the equation. Now we are going to calculate the amount of monthly obligations that appear on your credit report. For this, you will need it to obtain a copy of your credit report and look up all the monthly payments that appear on your report for active accounts. This is anything that you pay on a monthly basis. These items could include installment loans, credit cards, and student loans. Add all the monthly payments together and write this number down. To this, You need to add any other payment that you are required to pay, such as court-ordered child support. Do not include any daily living expenses or utility bills into this number. Add these additional expenses to the total you calculated on your credit report and keep that number handy. All right. Now that we have those two numbers, we can start to look at how much home you can qualify for. Remember, this is going to be oversimplified, but we're trying to understand the process and not give you an exact number. This is for your mortgage professional to determine for you. The way this is calculated is by taking your proposed monthly house payment, which includes your principal, interest, taxes, homeowner's insurance, and your mortgage insurance, and adding that to your monthly expenses you calculated above. To say it differently, this is your monthly payments plus your proposed monthly house payment added together. Now that we have your total monthly expenses, we take your gross monthly income and we divide that into your total monthly expenses. In other words, expenses divided by income result in a debt-to-income ratio. This number is very important in determining how much loan you can be approved for. In very general terms, lenders like to see a debt-to-income ratio around 43%. Although in some instances, like an FHA loan, a higher ratio would not disqualify you from certain loans. But if you keep your ratio around 43%, you will more than likely be fine. Understanding that this ratio is affected by your proposed monthly payment, your mortgage professional will adjust the amount of your loan up and down to stay within this range. A higher loan amount will result in a higher debt-to-income ratio, and a lower loan amount will reduce your debt-to-income ratio. It is really a balancing act, and your mortgage professional can let you know where your ratios are. If you would like more information on debt-to-income ratios and calculating yours, please send me a private message at the email address in the description. So this is the second part of getting pre-qualified for a mortgage and how much loan you can afford. In the next episode, we'll talk about what to do and not to do after you're pre-qualified for a loan. My name is John Collins. I'm with Southwest Funding, and I want to be your mortgage professional.